Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. I just got back from doing some stuff from outside all day, so I'm wearing a hat. I don't normally wear hats in here, but anyway, we're going to work through Twitter and give you my financial opinion on what I see in the markets, what people are talking about, recent news or things that are impacting commodities in the stock market or financial markets. So let's dive in. Give you my opinions here. So this is, if you want to follow me, it's at finding_finance. We've got findingvalue.com. That's if you want to go there and check out my website. You can see my portfolio. I'm very much long oil, precious metals, copper, commodities, diversified mining companies, all sorts of stuff in there. And I give midweek updates on what I'm doing, what I'm buying. I also do platinum question and answer sessions on the weekend. The next one will be on Sunday, 5 p.m. For anyone who's a member. So here's something interesting. It's Dr. Copper here. He says, giant Chile mines are struggling just as world needs more copper. Guys, this is coming, and it's going to be a very tight market in copper. These guys are the big boys. The big boy mines over in Chile, they're struggling to move higher. And we want a lot more copper than what perhaps the earth can give, given the projects that we've got in the pipeline over the next decade plus. Now, remember, these mines are declining over time. They ramp up, they can hold steady for a long time, and then they start to decline. And it looks like these big giant guys are starting to decline, which means we're not only going to have to need new mines to offset those declines to stay flat, but we also need a bunch more to increase production for what everyone thinks is going to be this gigantic renewable revolution, so to speak. Now, here's Holger, good old Holger. It says, it's the liquidity, stupid. NASDAQ 100 and the combined balance sheet of the Fed, ECB, and Bank of Japan move in tandem. So some of these markets are very liquidity driven. Liquidity is how much liquidity is in the system. What they've got here is in the yellow is the NASDAQ, and then G3, this white line, is the balance sheets of those three countries. So if the liquidity generally goes up, money likes to rotate into the NASDAQ, and I think also the cryptocurrencies. Keep in mind also that we've had a little bit of, we'll call it a little bit of a retreat in interest rates. Interest rates also gives a little bit of a floor underneath the NASDAQ for a period of time. If the rates are declining because of fears in the market and those fears are materializing in problems in the market, then I think the NASDAQ could potentially head back down. But if liquidity comes into the market and the fears reside, I think that we could see an everything rally to the upside. And that's where you see that wave 3 in the commodity market generally, is liquidity comes back into the markets. It finds its way towards commodities that are short, especially ones just like copper that we were talking about, copper, oil, uranium, nickel, aluminum, on and on and on and on. And that liquidity is going to drive the prices higher. It's going to be highly inflationary if you've got supply side problems with your commodities. It says, we cannot allow OPEC to set oil prices. That is our job. I just thought that was funny. Coming on down here, another one from Holger, good old Holger. Holger's our buddy, guys. Look at it. Look at this. Look at his picture. You know, he's little, he looks like he's annoyed a little bit or something. It says oil jumped 7.5% at the week's open after OPEC Plus unexpectedly announced crude output cuts on Sunday, with Saudi Arabia leading the way with 500,000 barrels a day of reductions from May. Wow. So we are reducing oil out here. I guess they've got their own little deal here, and I am surprised that they're actually doing this. But 7.5%, that's quite a bit of jump there. Good thing I got my oil in there. Check this out, guys. Look at this. Shoulder, head, shoulder, inverted head and shoulders, and now we're popping. We're popping big time. They're providing some juice to this move to the upside, that's for sure. The juice is worth the squeeze. Okay, DXY. So this is the dollar. Remember, commodities are priced in dollars. A lot of these things are priced in dollars. The declining dollar means higher commodity prices. So DXY looks like we are heading on lower. You can see that this is hopefully a similar setup to 2003, where we're very early in the bull market, and maybe we can get a big old compression in the DXY or a decline in the DXY, which will be fuel to the fire for commodities and a big tailwind if we were to get something like that, which I think we will get. Grady, I was like hearing from Grady. He says, miners always lag at big lows. Said in September, thought it was a blue false breakout. It was. Now it has a beautiful bullish reversal right on blue line. Big bases take time, and the bigger the base, the higher in space. Next move up should be one for the history books. So this is GDX versus GLD. That's the ratio if it decides to come up here. So there it is. There's your blue line. We've got the breakout here. Then you generally get a return move or break, false breakout, but it's a retest move. And then I think we're going to move on up. Totally agree. These do take time, though. They take time. They're not immediate. So GDX, the gold and silver mining companies, the big guys, should outperform gold itself. That's what we're looking for. I like some of the junior ones, too. I'm not saying to go micro cap, but I'm saying some of the junior guys like the $700 billion market cap ones could be nice. Again, 7% plus with the WTI oil price pop looking good. Here's USD. Again, says have a look at that gap up. It almost fills the entire wedge size. It tagged the upper trend line to perfection. So this is the gap he's talking about. It gapped higher here to the upside. And we're right against that resistance line of the wedge at about 80, low 80. I'd like to see a close above $82 a barrel. Then I'm going to get, stupid kitty bullish on it. So that's looking good. North Star Silver. This arc has taken over 10 years to form. It's sending a huge message to those who are listening. So what we're looking at is silver priced in US dollars. This is the arc that is being created. And we're back. Says a move below the 2030 area would take us to the key support zone below. A breakout here is the first time we should get excited. That's at 24 something bucks. This is a very important breakout at $28. It says when price closes a month above $28 with gold breaking out versus the SPX, we get a long-awaited go signal. We're talking like go to cloud 9 up there. But yeah, I think silver looks really good. Gold looks really good. Very bullish on the precious metals in general, including platinum. I know we've got a lot of platinum guys listening, and I'm definitely a platinum guy. It says only the third time in over 50 years, Dow Jones Industrial Average adjusted for purchasing power is rolling over. We had that in 1968. That was a commodity bull market. We had it in 99, which is a commodity bull market. And we had it in 2022, which is starting to drop down, where we have the beginning of a commodity bull market. So yeah, we're coming back below the neckline here. That's good. Gold and silver peaked down here at the bottoms. It peaked here in 77. And I think we're going to come all the way back down and peak somewhere in the late 2020s, perhaps. But that's the Dow Jones Industrial Average adjusted for purchasing power, PPIO. Coming on down, we've got, Milwaukee still has no inventory. It's worse now than in March of 2022. This is Milwaukee. I know this guy's talking about Milwaukee, but what I want to say is just the inventory levels are very low in real estate. I don't think you can have these blowout crashes in real estate without having inventory. You don't go into a hyper supply phase with no supply. I mean, it makes no sense, right? So the markets are still hot. We still have very low inventory levels. I do see home prices starting to increase in a lot of the areas around here, at least in Colorado. But yeah, it still looks good, and it doesn't look like it's going to crash yet, at least. Looks very tight market. Here's Charlie. I just thought this was interesting. He says, new monetary system very close to the USD denomination and DXY falling fast. Our long-term silver target is $600 to $750 an ounce. You will not be able to buy then, as no physical available. Get yours now, whilst you still can. And what I want to talk about was, could we run out of physical? And the dynamic here where we could really supercharge this to the upside for any of the metals, it doesn't matter which metal, is the retail sector could force a squeeze on the physical, which then in turn turns on the industrial users and squeezes the industrial guys will start to do a big squeeze. So it would be the retail sector soaking up all of the loose, we'll call it the loose ounces in the system. Then once it squeezes up, gets real tight, then I think the industrial users will just flat out start, panicking to some degree, which will drive prices way up there. We've got SRS Rock Report says, while Stephen is correct that this won't end well, CPI inflation is mostly due to oil price inflation. Even though the M2 money supply has contracted a bit, the better correlation of CPI, Consumer Price Index, is the oil price. Wait until the world hits the energy cliff. The energy cliff is basically when production falls and production supply falls, which will be inflationary, is what he is saying. And I agree. Historically, what happens is everything was driven by credit expansion in the system. Now it's starting to shift over to the supply side of different commodities, especially oil, because oil is the number one commodity. If we start to see oil price really rocket higher, it's going to manifest itself in the consumer price index. That is what's going to happen. That's what he's saying in this here, and I completely agree with it. And it is coming. This is from Cuppy. He said, global CBs are going to swap USTs for gold, and they are going to self-custody that gold, which will blow up all sorts of banks that rehypothecate and relend phantom gold. When gold breaks 2,000, TLT will break 100, and then the race is on to get size done fastest. And that's going to be a squeeze that happens in gold. And it's all this rehypothecated, relending crap in the gold market, which we've seen. This could all be coming to an end, and if it gets exposed, it could put on a massive squeeze in the precious metals. So this is not QE in one picture. October 2008, March, April 2020, and then look at March 23. That's a lot of money, guys. 300 billion, just getting or 370 billion in March. So 370 billion. That's a big chunk of money. That might be tailwinds behind NASDAQ and some of these other kind of melt everything up move. And gold is also, I think, going to move up because of this 370 billion added to the balance sheet. Okay, that's where I'll end there. But that's what I've got for today, guys. And hopefully you guys enjoyed the content. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. If you guys have any interest, we would love to have you in the community. We have a Discord channel. We've got a bunch of other things there that you can look at, a bunch of information, commodity related, shipping cycles, all sorts of stuff on the website. All right, guys, we'll catch you later. This is Finding Value.